It's time for Yahoo Finance's Market Minute. Stocks edge lower, the S&P 500 retreating from record highs amid tariff threats from President Trump. Shares of EV maker Nikola tanking after filing for Chapter 11 bankruptcy protection and announcing an auction of its remaining assets. Nikola said it plans to provide services for vehicles in use through March. Etsy sinking after revenue missed Wall Street's expectations, the e-commerce company citing slower consumer spending, competition, and challenging year-over-year comparisons as significant headwinds. And home solar provider SolarEdge shares jumping as a revenue beat and positive free cash flow offsetting a wider than expected loss. The CEO saying SolarEdge expects to maintain positive cash flow for the full year as the company is, quote, just getting started on our turnaround story. And that's your Yahoo Finance Market Minute. For more on what's trending on Yahoo Finance, scan the QR code below to track the best and worst performing stocks of the session.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. Hey, on today's show, Portfolio Checkup, we'll break down how investors can be smart with diversification. And how much is Meta CEO Mark Zuckerberg worth? Well, it changes day to day, and we'll explain. Plus, yesterday we tackled tips for first-time home buyers. Today I talked to the chief economist at Realtor.com, and we'll discuss moving out from your starter home to your second home or perhaps your first family home. All that and much more coming up during this hour. But first, we are 90 minutes into the trading action. Let's take a look at where major averages are. We are lower across the board for the Dow, the S&P 500, and the NASDAQ. Stocks falling amid new tariff threats. The S&P 500 pulling back from a record high. Joining me now, we've got Will McGough, who is the Prime Capital Financial Deputy Chief Investment Officer. Good to have you here with us. You say being smart with diversification is the name of the game. So how are you doing that right now?
Thanks, Brad, for having me on as one of the top wealth firms in the country. It's great to be on a show dedicated to wealth. Diversification matters more than ever this year. If you think about 2022, 3 and 4, especially in 23, market was up 20%, 24, market was up 20%. I doubt we're going to see another plus 20% trifecta here, 3 in a row. Got a new regime in Washington, D.C., which is going to add a lot of volatility to the markets as well. So I would be very prudent with asset allocation and maintain diversification this year more than ever.
And so with regard to that, where are you kind of broadening out your diversification at this juncture?
Yeah, so I think you have to look at it in equity and fixed income a little bit differently. With regards to an equity portfolio, everybody loves the Mag 7. Mag 7's great exposure. We're recommending to core it up this year, which means kind of get rid of the overweight to those growth companies, look a little bit broader, value bellwether companies that are just going to be a little bit less volatile than the Mag 7. Earnings growth numbers are hit right now, but I would say that we're at peak earnings growth. It's hard for it to exceed the teams that we're in right now. And so I think you're going to see a rotation. So being diversified across core large cap equities and also looking into small caps is a prudent play. For fixed income, we're actually working with our advisors to help educate clients that you should actually be in some duration bonds. Everybody can go get 4 or 5% short-term risk-free, but the risk for where rates are going to go is down, not up. So you might as well get the yield and plus any potential capital appreciation from bond prices going up as rates may go down.
Of course, one of the primary components to that Mag 7 trade, NVIDIA, they report earnings next week. What are you going to be listening for to further perhaps cement the themes that have really propelled the Mag 7 to the outperformance that we've seen in the markets?
Right. So they've been delivering on earnings growth. As I just mentioned, they're predominantly driving earnings growth for the S&P. Right now, forward guidance is the name of the game. The markets are a discounting machine, so you have to follow trends. There are massive trends in the market right now, and most companies are reporting good earnings looking backwards, but they're being very cautious with their guidance going forward. And so I think we have to watch NVIDIA here. Are they going to follow this trend of hitting earnings backwards looking, but being cautious forward looking? And it's just kind of the narrative that's creeping into the market right now that, there may just be a little bit of a slowdown in the Mag 7 with regards to earnings growth. You're talking about phenomenal earnings growth to above average earnings growth. But again, that's all taken into consideration with how investors are positioning their portfolios. And we think it is prudent to own the Exxon Mobil's, Procter Gamble, Walmart's of the world alongside the Mag 7, especially coming off the last 2 years.
It's interesting. And in some of those names that you just mentioned, a little bit more exposure to the everyday consumer. And as we think about that in the macroeconomic backdrop, that takes us to what the Fed is going to be signaling, at least through the meeting minutes once they get published here today. What should we be keeping close tabs on there as to how the Fed and the FOMC is thinking and talking about the consumer right now?
Yeah, so the consumer is the name of the game. I think the stats like the U.S. economy is 70% driven by the consumer. We've got to watch what's going on in Washington, D.C., which is both fiscal and monetary, and now executive with Trump. So the Fed is in a precarious spot. Inflation numbers last month ticked up. They've been cutting rates. So you've got a potential distressed consumer coming aboard with tariffs raising prices. Energy markets are still high. Trump wants to bring those down. You've got a potential for, all these government employees that are being laid off or taking the package to leave coming into the unemployment numbers. You've got a lot of the big companies moving more towards AI and less towards workforce. So I think we could see a situation where the narrative starts to change and the Fed is all of a sudden kind of stuck. Did they raise? Did they lower? Did they stay? And it's going to be, I think long term, they're at a higher neutral rate, which is good. We haven't seen that in decades. And so that could bring some, real earnings growth alongside nominal. But again, it's all going to come down to, how efficient is the government, especially Doge, at reducing the deficit, because if you look at every economic indicator through COVID, there was a spike in a return to normalcy. It doesn't really matter what it was, except the U.S. deficit. It spiked and it stayed. And so that's a big problem with regards to what's driving inflation. And so a lot of folks, peers of ours, other asset managers are seeing inflation come down. Again, it's forward-looking with the efforts of Doge, which could give the Fed a little bit of pause, comfort, and staying where they're at right now. Otherwise, if this inflation trend, if they're not successful, inflation ticks up where everybody's forecasting 2 cuts this year, you could see a potential 1 or 2 token increases just to help them combat inflation. But again, it's going to be a wait and see, and it's a fun market out there. It's we don't really have this many macro drivers at play at the same time. We haven't had it in a while, and it just makes it more fun as an investment professional, helping advisors help clients position their portfolios to meet their goals and objectives.
Yeah, well, more fun when you're able to get some gains along the way and navigate what is extreme volatility, as some of our guests have talked about as well. Just lastly, while we have you, Will, as you're really parsing through, and you started to mention this, some of the policy decisions that are coming out of 1600 Pennsylvania Avenue. At what point do you believe that the Fed will have enough of the data and the read-through and the pass-through from some of those policy decisions into the economy in order to then start to clearly make their own decisions and rate policy?
Yeah, so they've been in a tricky situation. Everything they have done to combat inflation was offset by the government with their deficit spending causing inflation. So I think that, again, they're independent bodies as they should be. It's how they were set up in the early 1900s. It's going to obviously factor into their rate decisions. And especially if we can get into a situation where they can have a higher normal rate and then the market, the longer term treasuries tend to plus start to come in like the folks in Washington, D.C. are aggressively trying to do, you could be in a good spot to where, that's why we're advocating for investors to have duration in their portfolio, because, the short term, if crisis happens and we get a recession, some geopolitical shock, the Fed is going to have a put in the market. So they're going to reduce rates. So the curve coming down is the more likely scenario, and you might as well be able to clip the yield and participate if the curve does come down as well by having duration. So again, it's a wait and see with regards to how the data is coming in and what the Fed says with their statements. They did a pretty big rewording last time, so it'll be interesting to see, how much of their rewording Fed statements are like super tankers. They don't change much when you're on the open waters. It's hard to change the course direction. So they started to like try to turn the wheel with the last meeting, and we'll see if they continue to do so or not.
Right. Will, thanks so much for taking the time here today. Appreciate it.
Thank you.
Let's check in on Meta shares here, extending losses after Tuesday's down day. The stock breaking a 20-session win streak on Tuesday. It closed 2.7% lower. A multi-billion-dollar drop in the bucket hit to co-founder and CEO Mark Zuckerberg's wealth. Mark Zuckerberg is the second richest person alive, according to Bloomberg, worth $252.2 billion, trailing only Elon Musk, who has around $397 billion. You can spot some other familiar names among the top 5. The majority of Zuckerberg's wealth is in Meta, and he holds a 13% stake, or 342.8 million shares worth around $245.6 billion. Rounding out, Zuckerberg's net worth is around $6.6 billion in cash and other assets. But with yesterday's losses, Zuckerberg's net wealth, well, it fell 2.7%, shedding just over $7 billion in value. And here's some added context. Zuckerberg's wealth has still grown more than 20% so far in 2025. That's a gain of $45 billion. And for comparison, that equates to over 2 times the size of Snap's market cap. Since Zuckerberg's net worth is so closely tied to Meta's performance, his wealth will fluctuate day to day, week by week, and so on. This wealth driver is not atypical among tech founders, CEOs, or heirs to family fortune, as financial growth can largely be tied to the success of one business until an asset diversification strategy is activated and managed across other investments. Coming up, everyone, I speak with the CEO of freelance services marketplace Fiverr about how creatives can utilize AI to grow their businesses. That's next on Wealth. Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, let's talk a little Toll Brothers. Missing first quarter results on the top and bottom line. Total home sales for the quarter also a miss. The company attributes the softer results to impairments and the delay in the sale of an apartment property, saying their core home building operations met expectations in the quarter. Oppenheimer views the results overall as, quote, solid, calling out gross margin as a highlight. Evercore ISI notes the challenging quarter, but also points out gross margins amid challenging conditions. Next up, Capital One is getting an upgrade at Bank of America. The stock raised to buy from neutral with a $235 price target. That represents about 16% upside from Tuesday's close. B of A is positive on the company's merger with Discover Financial Services, saying it could unlock near-term synergies and provide meaningful strategic and operation upside for the company longer term. The analyst says that the combined company could earn mid-teens plus returns on equity, which could lead to multiple expansion. Finally, Supermicro is rising, extending a week-long surge that is seeing the stock fully recover losses after a scathing report accusing the server maker of accounting violations last summer. The rally has been a driver by company report last week, driven by the company report last week, detailing ambitious long-term targets, which is boosting investor sentiment following the accusations. The stock has been on a tear, up more than 80% year to date. Well, Fiverr shares are pairing earlier gains after beating analyst expectations for revenue in its fourth quarter. The company also introducing new AI tools for freelancers on the platform. Joining me now, we've got Micha Kaufman, who is the founder and CEO of Fiverr. Micha, it's always great to grab some of your time here with you. Just want to get your own take, your own perspective on this most recent quarter and what you're rolling out, especially as you're looking through the broader trend environment for some of the power users that are on Fiverr.
Good morning, Brad, and thanks for having me on the show. So basically, we've opened the market today with the opening bell with our community, which is always a celebration, and we delivered a great quarter, Q4, finishing the year very, very strong and coming up with guidance for the year 2025, a very strong guidance, double-digit growth, high EBITDA margins, Rule of 30. We're very content with the results that we're delivering. And alongside with it, we just announced yesterday a major release of a suite of tools, AI tools, that are supposed to provide our sellers with superpowers. We call this the giga economy because we believe that these tools could turn a one person into a production house. And who knows, maybe the first $1 billion business coming out of Fiverr.
And so with that in mind, we're taking a look at that offering, the pricing tiers as well here. What have you noticed within the core user base of Fiverr and the type of services that they skew towards that make this a viable business opportunity long-term for the company?
Sure. So basically, the company in its very fundamental function is providing opportunities for freelancers. This is what we do. And we see how worried they are over AI and its impact on their careers. And what we've introduced is really a new take of how AI could be designed. So instead of AI being exploitive, feeding on everyone's creation and then churning out work that doesn't have any credits or opportunity for gains, what we're doing is we're creating their AI. We create personalized AI that is based on their world of creation, allowing them to enjoy both the credit and the upside, the compensations out of that work. And in the same time, it's actually saving them a lot of time of convincing customers that they're the right people to do it, because customers can play with these models on their own and building the confidence to work with the actual freelancers. Sometimes the models are so good that they can actually buy the work, but every work comes with the editing power of the talent that stands behind this model. So unlike other AI where you're left alone to deal with the results, here you always have the actual talent to bring you to the finish line to get exactly what you're looking for as a customer.
And for those creators, for those freelancers, how are you seeing them successfully create even more business opportunities, cutting down the amount of time that it takes for them to perhaps respond to business inquiries and even produce and get back to and generate even more clients by the use of AI, and how you're expecting that to grow over the next few years?
So the good news is we've announced yesterday two pieces of new technology. One is the creation model. The other is an AI personal assistant. The idea around this, and there's between yesterday and today, there's thousands and thousands of freelancers that already activated this personal assistant. The idea is that what we've noticed over the years is that the first 3 minutes after a customer contacts a freelancer are the most crucial time for conversion. And freelancers also need some time to rest, and sometimes they're just busy. Now they have the assistant taking on customer inquiries, and it does it instantly. And it does it very personally because the personal assistant is entirely based on the world of that specific freelancer. So it knows how to handle the most complex questions, and it's actually being a salesperson for that freelancer, making sure that deals are getting closed. And what we're seeing between yesterday and today is that this is exactly what's happening. Those assistants they don't appear to be like chatbots. They talk in very natural language, so much so that some of our customers weren't sure if they were talking to AI or to an actual person, and they're converting really well. And this is all happening while the freelancer is sleeping or just busy on a different task. So we think that this is going to be a game changer over time. And over time, as the assistant learns how to work with a freelancer, they would also become a business partner, allowing them to get insights into how they can improve their visibility, their business, to get more exposure and more business.
Micha, just lastly, while we have you very briefly here, it's not often that we hear public companies announcing equity programs for some of the power users on their platform. Break down how Fiverr is going about this.
So essentially, I've been wanting to do this for a long time, and I'm super happy that we've got to do it now. The idea is that we're taking the top performing freelancers, the people that are the heart and soul of our community, our movement. And we say that if we shape the future of work together, they should own a piece of it. So essentially, those who are mostly loyal to the marketplace, those who build their career on the marketplace and grow their business over time, we want to give them a piece of the success. And I think that this creates an incredible alignment between the success of the company and their success. Everything is intertwined.
Micha, thanks so much for taking the time here. Good to reconnect with you. Thanks so much.
Thank you for having me.
Certainly. We've got all your markets action ahead. Stay tuned. You're watching Yahoo Finance. Let's get a quick check of the markets here, everyone, as we are taking a look at the major averages as we're 2 hours into today's trading session, roughly. Dow Jones Industrial Average right now down by about 0.3%. The NASDAQ Composite, that also in negative territory by 0.1%. Trying to make a little bit of a move higher here, see if we can get back to where we closed at yesterday. It's the climb, and it's still happening right now, but ultimately still in the red. S&P 500 flat, just barely to the downside. There, too, seeing a little Miley Cyrus action. It is the climb. We'll see if we can get into positive territory and hold on to those levels throughout the rest of today's trading activity. Let's also just take a brief look at some of the heat maps, see exactly what's under today's trade. We'll start off with some sector activity. Energy leading the pack right now. That's up by about 1.2%. However, bringing up the caboose, you've got materials. That's down by about 1.2%. And that largely on the back in terms of the move that we're seeing as the tariffs have continued to be talked about and the inaction getting all the more closer of that. If we do see those rolled out, of course, steel, aluminum, some of those materials that we're going to be tracking very closely over the coming negotiations on the tough tariff talk. Also here, as we were taking a look at energy, one of the leaders, you've also got healthcare. That is breaking out. Right now, it's up by about 0.9%. And so we'll see how that continues to fare on the day. More decliners, though, than leaders as of right now. Let's check in on the tech-heavy NASDAQ as of right now. This is the NASDAQ 100 that we've got to look for you here at. And NVIDIA right now, you're seeing that higher by about 0.5% early in today's trading session. Tesla, that catching a bit of a bid right now. That's up by about 1.7%. And then additionally, we've been keeping close tabs on Meta. Their eyes were watching Marky Mark and the Funky Bunch, it's down right now here on the day by about 2%. That after we had seen a 20-session win streak snapped on Tuesday to begin this week. So ultimately, looks like we're adding on to some of those declines here during today's session, down by about 2% for Meta. We'll continue to track all those names and much more throughout the rest of the session. Switching gears. Layoffs might be coming for the Federal Housing Administration. Bloomberg reporting the Trump administration plans to lay off nearly half, or 40% of workers at the agency. A spokesperson for the Department of Housing and Urban Development, HUD, which oversees the Federal Housing Administration, denies that about half of the workforce at FHA will be laid off, but they did not confirm or deny whether there would be layoffs. Yahoo Finance's Claire Boston joins me now. Claire, let's back up perhaps for a second here and just start with exactly what the Federal Housing Administration does.
Yeah, that's right, Brad. It's a very fast evolving situation. So the FHA does not directly make mortgages, but what it does is it provides mortgage insurance on loans that go mostly to families who may not otherwise be able to qualify for, that conventional mortgage. It insures more than 7.8 million single family mortgages. So that's a pretty sizable part of the market. Depending on the year, that's maybe 10 to 15% of the overall mortgage market. So they play a really key role in giving access to credit, especially to those maybe like lower income type borrowers.
And so what is that impact on access?
Yeah, so it is a very quickly evolving situation. I'm still talking to people. And the biggest concern that I'm hearing right now is that this could really slow down the process for getting those loans. More than 80% of FHA borrowers are first-time homebuyers, and proportionately, the FHA serves more Black, Latino, and low-income borrowers than elsewhere. So, potentially we are really talking about an access problem when it comes to accessing mortgages down the line.
Claire, thanks so much for continuing to track this and breaking this down for us. We'll keep close tabs on it as well. U.S. housing starts slowing in January as builders pull back on construction amid fears and growing fears over high mortgage rates, affordability challenges, and unsold homes. New construction fell nearly 10% to an annual rate of 1.37 million homes, falling short of Wall Street's estimates. Here with more on the state of the housing market, we've got Danielle Hale, who is the chief economist at Realtor.com here. Great to have you back on the program. So first, just walk us through some of the dynamic here that we're seeing in new construction.
Yeah, thanks for having me, Brad. So, in the new construction market, as you mentioned, there's some uncertainty that builders are experiencing right now, and we see that reflected in the data with that pullback in starts. Now, there are a couple of good things happening in that data. One is that completions ticked higher, so builders seem to be in get it done mode, trying to close out construction projects that are already underway. That will near term boost supply, which will be good for buyers, but will make it a little bit more challenging. Builders will have to compete with each other to get rid of and to sell that inventory. Looking further ahead, as you noted, starts are down. That was pretty much in both single family and multifamily types. But looking at the permit data, which is about what is, even further into the future, we saw that that data was roughly flat. So not quite as bad as you might expect, given the concerns that builders have about buyer traffic and tariffs and costs down the road. But they're sort of taking a wait and see approach, getting the permits, holding some optimism for the future, but not quite moving forward with projects, perhaps until they get a little bit more certainty.
And so with that, there is the uncertainty of what the cost could be, because we're already at some of the record high prices. And so now, if we did see even more costs that have to get passed through to potential buyers, how are we essentially running the calculus on how much higher the costs could go for potential buyers as well?
Yeah, I think costs have actually been a challenge for home shoppers in the market. New homes have done a better job of being flexible. So builders have targeted smaller footprint homes to help bring down those costs. But if their costs rise as tariffs go up, or if it's harder for them to find workers to build those homes, they're certainly going to try to pass those costs on to consumers. And with mortgage rates remaining very close to that 7% horizon, it's going to be challenging for them to do so. So I do think that puts builders in a challenging position, and that's why we see some of that hesitation in the starting activity.
Danielle, while we have you, I want to take a quick pivot. On the show yesterday, we discussed best practices for buying your first home. And today, we want to talk about moving out of your starter home and into your next one. Maybe you have a family and you're now shopping around. So talk to us about how your mindset shifts from starter to second home, and perhaps give the folks at home some tips for their shopping journey.
Yeah, absolutely. So I think going from a starter home to a larger home can happen maybe sooner than people expect. There's survey data that shows that often people expect to be in their first home a bit longer than actual sellers indicate they're in their first home. But it's great to be able to make that trade up. It's a bit of a challenging market to try to do that right now, but there are some things that consumers can keep in mind. The first, I would say, is to be aware of what are your non-negotiables. Is the school district the most important thing for you? Are you more interested in size and space or proximity to the office? Whatever your non-negotiables are, figure that out and lock it in up front. It'll make it easier for you to make trade-offs down the road, because we know that consumers have to make trade-offs. The other thing to consider is being willing to buy during the off season. You'll get better pricing. You might sacrifice options. We do see more for sale homes in the peak spring season, but you'll get sellers who are potentially a little bit more flexible if you're buying during the shoulder season, which is typically in the fall. The other thing that you want to do is focus on the things you can control. You cannot control inflation. You cannot control the Fed policy and what's going to happen to mortgage rates, but there are things that you can do to get a better rate for yourself. Those include improving your credit score, lowering your debt to income ratio by either paying down debt or trying to grow your income, focusing on your loan to value ratio, either reducing the price of the home you're looking for or making a larger down payment. And finally, the thing you can do the easiest is shop around among lenders. All of those things can contribute to a lower mortgage rate, regardless of what's happening in the market.
Is there a sweet spot right now for the down payment that people should have saved up?
You know, it's going to be different for everyone. The larger the down payment, the lower your monthly costs. But, I think we see a lot of repeat buyers in the 13% or so range. That's about the average. So that's a good target. Of course, if you've seen some nice price appreciation in your starter home, you might be able to put a larger down payment. And that certainly makes those monthly costs lower going forward, which is a nice help when rates are high.
Excellent, excellent. Danielle, thanks so much for taking the time.
Thanks for having me, Brad.
Certainly. Coming up, $124 trillion in wealth is expected to change hands through 2048. We're talking about the great wealth transfer after the break. $124 trillion. You heard that right. $124 trillion in wealth is expected to change hands through 2048, according to Cerulli Associates. $105 trillion of that is expected to flow to heirs, with $18 trillion going to charity. So with all of that money already flowing from one generation to the next, we want to talk about risk management practices to help people properly protect their wealth. Joining me here in studio, we've got Mary Lago, who is the Chief Wealth Strategist at Ferguson Wellman Capital Management. Great to have you here in studio with us.
Thank you so much for having me, Brad.
Absolutely. So let's talk about this a little bit. The great wealth transfer and how people can set up a holistic approach for both passing on wealth and inheriting wealth.
Exactly. So with all of this wealth in transit, it's important, there are important implications for both the givers and the receiver. And so you want to transition that wealth to happen in a way that maybe benefits not only from the wisdom of the investment knowledge that has helped build these resources, but also incorporates the values of the individuals that will be giving these funds away. For those who will be receiving the wealth, it's important that they get exposure to those concepts, to start with basic things like investing and wise tax strategies. And there's some great tools available to help build that comfort. So one other important point here is that with women living longer and with more women in younger generations being involved, more women are controlling wealth as we look to the future.
Certainly. So how are you advising clients to get started?
Well, in terms of simple steps that individuals can take to start building comfort level at the younger generations, if you have young individual family members who are early in their careers, setting up a Roth IRA is a great opportunity to start build some comfort with investing, as well as having some skin in the game so that they really care what's happening. It also has other benefits such as growing tax-free for a long period of time. Donor advised funds are a great way to engage individuals with your philanthropic values. So that not only, again, has great administration ease and tax benefits, but really helps instill some of those values and transfer some of those discussions around why are you giving and what do you hope the benefits will be. As investment advisors, we're really focused on managing the risk in the investments. And so many higher net worth individuals have the challenge of some embedded gains. They have concentrated positions. And we say in the industry, concentrations build wealth, and diversification retains it. But there's this balancing act between can we just position the portfolio in an ideal way, or what would be the tax cost of doing that? And so it's often being done over a period of time.
With that in mind, when you talk about risk is viewed differently among different generations as well. And so when you see and think about some of the sectors that might see more inflows as this great wealth transfer takes place, what are those sectors that are set to benefit the most, perhaps?
Well, more than looking at the sectors, I mean, certainly we look at the younger generations, they're more comfortable with things like technology. They believe and they've seen more of the benefits of those. I guess I think of it more in terms of, I think of it less in terms of which sectors are set to benefit and more what are the ramifications and how can we help equip these generations so that they're going to be prepared and engaging them in the process, also paying attention to the taxes. Right now we have a 40% federal estate tax. So as this wealth transfers without proper planning, that's going to get a 40% haircut, and some states also have a state level estate tax.
Yeah. So all that in mind, as you're thinking about some of the current clients that you're working with and onboarding even new clients at this juncture, what is the number one question that they're asking about how they can just manage this incoming wealth that much better?
It's really about knowledge. How can we help equip the future generation so that they are prepared? And it's using some of those simple places just to get started, maybe bringing them along with you to meetings with your investment advisor, with your CPA, with your attorney. So we encourage individuals not only to build up their own skill sets if you're going to be on the receiving end of some of that wealth, but also to build a team around you. So again, it's that triad of an investment advisor and a CPA and an attorney that can really help guide, because depending on your situation, the risk might look quite different. For someone with a moderate level of wealth, there's maybe moderate risk exposure to taxes, but maybe they have a small business that has concentrated risk. They own a healthcare business, for example. They're not going to want to be building healthcare stocks within the liquid portions of their portfolio. They want to build their liquid wealth in a way that's complementary to other things that they may have in their life. Could be real estate, whatever it is. Pay attention to their particular portfolios, their particular risk, and build around it.
Really solid insights. Mary, thanks so much for taking the time.
Thank you for having me, Brad.
Coming up, Apple is introducing a new low-end smartphone called the iPhone 16e. We break down the announcement with our tech editor after the break. A programming note: on a new episode of Trader Talk, Kenny Polcari sits down with Tom Hayes of Great Hill Capital to discuss how tariff-induced investor panic creates market opportunities, the power of long and short strategies, and navigating volatility in today's dynamic economy.
I think you want to go where earnings growth is accelerating, okay?
Right.
So last year, earnings were the name of the game for the Mag 7, okay?
Right.
They had 33% earnings growth, which was double the market. They should get double the multiple. This year, earnings growth is decelerating from 33% last year for the Mag 7 down to 21%. The multiple has not contracted in line with that decelerating in earnings growth. The rest of the market had negative earnings growth the last first 3 quarters of last year. It's now accelerating, and the multiple is half of the Mag 7.
And you can catch Trader Talk with Kenny Polcari every Wednesday, 12 p.m. on Yahoo Finance or wherever you get your podcasts. This Black History Month, we celebrate the power brokers in business, executives, entrepreneurs, and proven change makers who have advanced economy and society. Morgan DeBaun is the founder and CEO of Blavity Inc., a global corporation that has transformed media for Black consumers and businesses. Morgan also serves as an angel investor and advisor to American Airlines, PepsiCo, and the Black Economic Alliance. Joining me now, Morgan DeBaun, Blavity Inc. CEO. Morgan, great to have you on the program with us. You frequently share tips and founders and entrepreneurs on your social media platforms. I see it all the time. You have a lot of folks that are looking to secure funding in a more cash-strapped environment here where VCs are more scrutinous about the money, the capital that they're deploying. How have you seen this change over recent years?
Yeah, thanks, Brad, for having me. I think when we first started 10 years ago, when I was first raising capital, you would always hear those stories of people raising money with an idea on a whiteboard or an idea on a napkin. Those days are over. Early stage VCs are looking for founders and entrepreneurs who have profitable businesses that have product market fit and are looking to basically say, if I give you $1 million, how are you going to give me back $3 to $5 million? So you have to be much further along and really know what you're doing.
With that in mind, you've been able to successfully build up your own media businesses that continue to grow. What are you seeing within the media environment right now as perhaps some of the broader shifts, tectonic shifts that are taking place that smaller players are able to really make sure that they're nimble and make sure that they can also be able to latch onto and go to market that much more quickly?
Yeah, the trends that are really taking off right now is that creators. Creators are now our go-to source for information, for content. You see deals like podcasters getting huge brand deals, huge distribution deals. So old school traditional media is really struggling because they used to be the source of truth. They used to be that clearinghouse of information, but consumers, they don't trust legacy media as much anymore. And so they're looking for people who share their values to give them the information straight to their phones, whether that's on platforms like TikTok or Instagram or even Blue Sky now.
And so with that in mind, from the top down, what does leadership look like to you, especially as you're engaging with a very diverse set of leaders who you're looking to build up within your own organizations and folks who work with you on a daily basis?
The fundamentals of leadership, I don't think have changed regardless of the trends, whether it's AI or, the D&I adjustments. To me, the most important thing is making lasting impact, making sure that our company is staying focused to our values. And when you're really trying to grow into a leader, whether you're early in your career or just starting your first company, you really have to think about what is the change that I want to make? What's the problem that I'm trying to solve? And make sure that you're able to bring people along the journey with you. Because if you really want to change the world, if you really want to build a product at scale for millions of people or billions of people, then it's incredibly important that you're able to bring people with you along the way. You can't do it alone.
There are a lot of people who get into business that just say, hey, I want to make a big buck over time and generate wealth. And there's nothing wrong with generating and growing wealth. Sustaining it over time, even more of a challenge. What would you say is perhaps your top tip for entrepreneurs who are trying to grow and build wealth?
I think a lot of people focus on income. They focus on that top line revenue. They focus on, their personal income if they're a solopreneur. And I think what's more important is to focus on building assets, to focus on what is the true value that you're building. How are you taking the income or the revenue that your business is creating and making sure that it's institutionalized through assets and ownership? Whether you are an employee and you're getting stock in the company that you're working at, or you are a first-time entrepreneur trying to scale your business, making sure that you own the business that you're scaling is really important, because more often than not, I see founders going through rounds of funding and then they wind up with a very small ownership stake and not much power or control in their own company.
That's a very good point. Just lastly, while we have you here, Morgan, as you think about how the landscape is changing for creators, we just had the CEO of Fiverr on earlier telling us about how AI is really going to reinvent the way that creators are able to go to market and own more of their own product. How do you see AI changing the landscape for creators as you work with them, both on the media side and even just more broadly in content creation?
You know, AI is my favorite tool right now. I'm using it so much in my day-to-day work, as well as training our teams. We have a training every week at our own company to train our own team members and employees on how to use it responsibly. I think for creators who are thinking about how do I use this and not be scared of this tool, you should really think about your intellectual property. So what makes you unique? What is your niche? What is the value that you're creating into the world? And then how can you use AI to amplify that, to speed up your workflows, to streamline the amount of content that you're creating and the quality of content that you're creating? You used to have these long processes to build, amazing videos or write incredible scripts, but now the go-to-market should be much faster. So I think we're going to see a lot more creators be prolific and the breadth of content that they create and the speed in which they create it.
Morgan, it's been great to track your ascension in business over the years. Continued success to you, and thanks for joining us here on the program.
Thanks for having me, Brad.
Apple just unveiled its new, more affordable model iPhone called the 16e. Our very own tech editor, Dan Howley, is here to tell you everything you need to know about the new device here and whether or not I need to get it. Dan?
Yeah, Brad, this is basically the I would say next generation of the iPhone SE, which was their more affordable iPhone. They've kind of changed the naming of this, so it's the iPhone 16e, but the general idea behind it stays the same. Rather than the $799 that the iPhone 16 costs, this comes in at $599. It has an updated design from what the old SE had, so you have an edge-to-edge display. At the top, you have a little cutout, so it's kind of like the iPhone 14, but you do get Face ID, you do get Apple Intelligence. You also get the A18 chip, which is the latest chip that's in the 16 and 16 Plus. So you're getting cutting-edge processing power on there. You're getting a good amount of storage as well. The main difference, I would say, is that you're not getting two separate cameras that you would get on the base iPhone 16 or iPhone 16 Plus. You do get a standard camera as well as kind of a 2x telephoto that's worked in there, but it's not going to be that exact two-camera setup. You also get an OLED display, and one of the bigger things to talk about is that this is coming with Apple's C1 chip, which is its first in-house designed cellular modem. So rather than using something from Qualcomm, Apple's using its own design chip. And so what does that mean? Well, it means they don't have to pay royalties or the price to Qualcomm for the type of chip that they're offering, but they also now have more control over the design of the phone itself, as well as how much power it can consume. So you would imagine that including this would fit in with Apple's plans for reportedly a thinner iPhone 17 to come, and then perhaps a foldable iPhone in the future. Adding its own chip in here allows it that much more flexibility. So it could be part of Apple's overall strategy. We just have to see how it performs compared to the Qualcomm-based chips in the past. But better battery life, they say, USB-C, and again, it comes in at $599 compared to that $799 price for the iPhone 16.
All right, Apple shares up right now by about 0.2%. We'll see how they continue to move on this news. Dan, thanks for breaking it down.
Thank you.
That's it for Wealth, everyone. I'm Brad Smith. Thank you so much for watching. You can stay tuned for Market Domination coming up at 3 p.m. Eastern Time.